Okay, good afternoon, everyone, and welcome to this webinar where we're going to be exploring the Pillar 1 potential implications of incorporating climate risk measures that the Basel Committee have been talking about and have helped produce a number of guidance and standards around. Before we get started, let me just do a quick introduction to myself. My name is Aziz Durrani. I lead the technical assistance function here at AMRO. And I'm joined by two very special speakers, Julia and Pierre, today. So let me just give them a couple of minutes to introduce themselves. Julia?
Hey, good afternoon, everyone. My name is Julia Bingler. I am a fellow on monetary policy at the Council on Economic Policies, which is a think tank based in Zurich. And I'm also a research associate at the University of Oxford on financial risk data analytics. I have been working in the area of climate risk measurement and integrating of climate and nature risks in financial supervision now for some years. And I'm glad to hand over to my colleague Pierre for the introduction of himself.
So, can you hear me well? Good, yeah. So good afternoon, everyone. I'm Pierre Monat. I'm a senior fellow at the Council on Economic Policies together with Julia. I'm also visiting professor in practice at the Grantham Institute at the London School of Economics. And I've been working on the links between central bank and climate and financial supervisors for quite a long time, looking at how climate change affects the job of supervisors and how supervisors can also impact climate change. Lately, I've been mostly working on macroprudential policy, which is also part of what Basel is looking at, and I will talk after Julia on this topic.
Okay, thank you very much, Julia and Pierre. So before we get started, just a quick welcome to all our guests as well. We've got a range of people here, not only from AMRO itself, but across our member authorities, ministries of finance and central banks across the ASEAN +3. And we've also got a number of members from our ASEAN +3 financial think tank network, including the ADB Institute, and also a special welcome to the Foreign Trade University in Vietnam, who are also joining us for this. So we're very excited to hear your thoughts and analysis of the situation. And of course, to kind of give some background, after climate risk sort of started gaining prominence in terms of actions that supervisors and central banks need to take across the banks they supervise. One of the big issues was that it wasn't incorporated within the Basel Framework, and a lot of these risks are sort of externalities, so not being priced into the loans being made and so on. And so there was quite a lot of pressure on the Basel Committee to try and incorporate some of this into their framework. And whilst they haven't introduced new climate risk measures per se, they have produced quite a bit of guidance, guidelines, standards, and also discussion around how it should be considered within the Basel III framework. And hence, we thought it'd be useful to have this session to talk through how supervisors and others in the financial sector, when they are looking at this issue, how it should be priced in, and what the expectations for the banking sector and other financial players should be. So that's a very quick introduction, but I'm sure Julia is going to talk us through the first part of this presentation and go through the key details of this. So Julia, let me hand over to you.
Yeah, thank you very much, Aziz, and I'm very glad that we're doing this webinar together with AMRO. It's great to be teaming up on these core issues, since the implementation of Basel III is anyways on the agenda of most supervisors, and it's a great time to consider how to get it right from the start with regards to climate risks as well. So let me start with sharing the presentation, and we will have a total of 45 minutes approximately of input from myself and Pierre, and then afterwards some time for Q&A. I guess you need to raise your hand for the Q&A, so if the chat doesn't work, so just try to raise the hand and we will moderate that afterwards. So as Aziz mentioned, our topic today is the financial supervision and emerging risks in the Basel III provisions and a bit beyond, with a focus from my side on how to integrate climate risks in Pillar 1, and with Pierre's focus afterwards on how to assess and integrate them in systemic buffers. So I will first talk about the Basel III purpose and the climate risks in Pillar 1 in general. So why does it matter? Then about climate risks in Pillar 1 in terms of the asset valuation components. Then third, on the risk weight components. And fourth, I will talk about some of the next steps that have been taken by some supervisors in order to integrate climate in Pillar 1 or to plan to integrate it, and suggested next steps that would also be useful to undertake. So the Basel III purpose and climate risks in Pillar 1 basically relate to the core of the entire setting up of the framework of Basel III, which is to set a foundation for a resilient banking system that will help avoid the buildup of systemic vulnerabilities. So there's a clear component to prevent excessive risk taking and also prevent systemic issues. And then second, to reducing mechanistic reliance on credit ratings by requiring banks to conduct sufficient due diligence. And this second part guides also the Basel's own guidelines and FAQ and principles on how they suggest climate risks should be taken into account in general in the current prudential framework. The prudential framework itself is basically a combination of preventive and preemptive Oh, I've seen a hand being raised, but I don't see who did that. Okay, never mind. Of prudential considerations in terms of preventive and preemptive activities, and however, to date, as it stands now, it's mainly based on reactions to past events and to past issues in the financial sector. This will be important later on when we talk about the core principles in a review, because they start to change that towards being more preventive, preemptive. The reason why such a discussion is important is that it bears different implications on who bears the costs and the risks. And the more reactive it is, the more costs are borne by the standard businesses, normal enterprises, the real economy and people. And when it's more preemptive or preventive, the costs and some of the risks of the issues actually not materializing are borne by the financial sector, or mainly banks in the first stance. So why do we talk about the need to reconsider the Basel requirements as they stand now, and also to adapt them to climate-related risks in a better way? We have seen on the one hand side that Basel already captures many of the aspects that are issues with regards to climate. I will talk about that in a minute. But also we have seen that the Basel regime itself might not be sufficient for safeguarding the resilience of the financial sector. So, for example, last year there has been the Silicon Valley Bank collapse and the associated issues in contagion. And Michael Barr, the vice chair of supervision at the Fed, said lately that, as we learned earlier this year, banks with inadequate levels of capital are vulnerable, and that vulnerability can cause contagion, which threatens the stability of the banking system and hurts families and businesses. So here we see it's a clear issue raised in terms of we need to be proactive and preemptive. A clear message from the failure state was regulatory requirements, including capital requirements, must be aligned with the actual risk so that banks bear the responsibility of their own risk taking. Talking about actual risk in the context of climate risk is super important, because it's not a backward-looking risk, it's a forward-looking risk, and hence capital requirements might have to be aligned with that risks as well. What we've also learned in the last crisis is based on what the board of the governance of the Fed on the review of the supervision and regulation of the Silicon Valley Bank finds in their report is we need to develop a culture that empowers supervisors to act in the face of uncertainty. This also very much holds for climate-related issues. In the case of SVB, supervisors delayed action to gather more evidence, even if weaknesses were clear and growing. This is also a key concern for anything climate and nature related that we see at the moment. This means that supervisors did not force SVB to fix its problems, even as those problems worsened. So that's a clear call to action for supervisors with regards to any emerging risks, amongst others the climate and nature risks, to become more proactive, even if uncertainty is prevalent. And that's why, for example, the ECB very early on started to say they subscribe to the view that climate-related risk can be a source of financial risk, and to that extent it falls within the mandate of central banks and supervisors to ensure the financial system is resilient to these risks. And this, how to ensure the financial system is resilient to these risks, is the core work that needs to be done now. So in Basel, we have the three pillars covering, on the one hand side, regulation activities, supervision activities, and disclosures or transparency. In pillar one, we have the regulatory capital requirements. So the core is that a capital adequacy ratio, which is composed of tier 1 and tier 2 capital, and the denominator, the risk-weighted assets. And the risk-weighted assets will be the focus of the pillar 1 adjustments, and are the focus, like in today's presentations, but are also the focus of the adjustments as recommended by the Basel Committee as it stands now. The risk-weighted assets have basically two components to be calculated. It's on the one hand side the asset valuation itself with the standardized approach or the internal models approach, and the assigned risk weights. It covers credit risk, market risk, and operational risk as it stands now, and we will focus mostly on the credit risk components because Basel has been most detailed about the credit risk parts. What we know is that climate risk poses a core challenge for standard financial risk analysis. On the one hand side, in terms of fitting distributions, which are the underlying inputs for any risk assessment. So in terms of the data and the shape of the distributions. Second, also in terms of estimating the risk itself. Mean estimates has been shown to be not informative. There are fat tails and non-symmetric distributions. And value at risk and expected shortfall have been shown to be just one value that might not properly capture the risks as they emerge. Second, beyond the quantification of the risks, the uncertainty component is prevalent. So there are known unknowns and unknown unknowns. So there's deep uncertainty associated with climate and some nature-related risks. There's tipping points which have an impact on the estimated frequency and intensity of the risks. The trigger points in terms of the effect on the speed and the scale of the technological and societal transition. So this is more the transition risk component. And most important, the uncertainty itself or the risks are endogenous and compound by physical and transition impacts. That makes it super hard to use standard financial risk analysis to capture those risks right. And then we also know that financial markets in general might not work well. So in the face of climate change. So we have been seeing analysis by central banks that say risk diversification might not help. If things go back, a bad risk correlation becomes 1. And for climate, the risk correlation is already right now probably 1, even in presumably unrelated sectors and geographies. And the assumption that if prices drops, that deficits could be solved, has been proven wrong. So what does this entire landscape mean? Basel started to try to understand what it means for the Basel regime in terms of first assessing the risk drivers and mapping them to the Basel pillars. This has been done in 2021 already. So the risk drivers based on climate-related risks basically via certain transmission channels end up in the core standard financial risk: credit, market, liquidity, operational as defined by Basel, additional ones as defined by other financial institutions. So they clearly say they impact basically almost all components of the Basel framework, for sure each pillar. And for example, for credit risk, they impact the standardized or the internal ratings-based approach, equity fund investments, central counterparties, and so on and so forth. So I will not go into detail of this graph, but it shows you that Basel has identified climate risk drivers as being already today incorporated basically in the core risk drivers that end up in financial risks and need to be hence considered for each of the pillar implementations. The colleagues from Bank Negara Malaysia also have mapped the climate and economy feedback effects to that, the economy and financial system feedback effects, and the financial system contagion effects, which are in addition super important and have not been that explicitly mapped in the Basel requirements. So the issue is basically that financial markets today are not able, in terms of tech, like model-wise, and also not able in terms of the complexities to price the issues correctly. This has been shown in a vast amount of academic literature. And so this is why additional activities might be important and are important to be undertaken by supervisors in order to safeguard the financial system from these risks. So the issue basically has been also introduced in the Basel core principles update in the consultative document from last year. And the core principles are basically the heart of the Basel regime. They are the minimum standards for the integration of regulation and supervision of banking systems, universally applicable and very important also for emerging economies. They are used by the IMF and the World Bank for the financial sector assessment programs, which means in the end, not applying these principles or basically not applying them well might lead to also higher credit risk assignments to the sovereigns and eventually higher refinancing cost for the sovereigns. So the reason why Basel undertook this new core principles review was that there were current regulatory and supervisory developments, not only in financial risks and operational resilience, but also the systemic risks were not well enough defined and addressed to their understanding. And new risks, emerging risks, including climate-related financial risks and digitalization, would have to be tackled more explicitly in the current provisions and to some extent also explicitly in additional provisions. So we have, when we see the changes of the Basel core principles as they stand now in the consultative document, we see that they have much more preventive considerations. We see that they have additional information requirements explicitly for the information on the assessment of materiality of climate-related financial risks and other emerging risks. We have that emerging risks and capital adequacy are addressed, so that in order to have a sound financial system, the risks might have to be assessed over the relevant time horizons, but also be taken into account in anything related to the further risk management and credit risk management of the banks. And that additional capital requirements might be basically in the toolkit of supervisors, which might not be based on the standard risk-based measures, but in order to supplement these, the risk-based capital requirements can be adjusted to also have additional capital add-ons to contain the buildup of leverage in banks and the banking sector. In addition, there is a provision that, for example, additional capital, including potentially sector capital requirements, so that's an implicit clear reference to climate risk very exposed sectors, for example, is another suggestion that they pose now. So we see that there's basically a strong understanding within the Basel Committee at the moment, as it stands now, that the emerging risks are within the framework to some extent and need to be assessed, but also that the framework itself might have to be reviewed in the near future. And we will focus today on how the framework already addresses the risks today, and now focus on the asset valuation components of the Pillar 1 aspects. So the core documents that Basel issued here are the Principles for the Effective Management and Supervision of Climate Financial Risks and the FAQ on climate-related financial risks. Whilst the first one rather focuses on Pillar 2 related issues, the second one is mainly on Pillar 1, and that will also guide our considerations today. So as of January 2023, the Basel III official framework, as you find it on their homepage, integrated the FAQ elements into their standard provisions. So for example, when you look at the credit valuation of risk-weighted assets for credit risk, you have the due diligence requirements, and there you have the footnotes and the FAQ, and the FAQ points to how banks should actually consider climate-related risks. So Basel has already included explicit wording on climate-related risks across its frameworks, and it's basically already now part of the framework itself. And it's super important that supervisors are aware of this and integrate this wording exactly as the other wording in the implementation of the Basel III requirements when they move from Basel II to Basel III, for example. So there's various examples where climate-related risks need to be taken into account. It's mainly in the due diligence parts, both of the internal and of the standard approach and the internal rating-based approach. And it's also with regards to overrides when determining grades, for example, grade A, but also in general. So I very much recommend you all to read through this FAQ document and assess where this has been integrated in the official standard Basel framework, because this would then guide your work when issuing guidelines, for example, on credit risk assessment. So in sum, the Pillar 1 due diligence provisions as they stand now from the Basel Committee say that climate risks must be integrated into existing standards. Banks should include material climate financial risks in internal and external risk assessments. Banks should establish an effective process to obtain and update the climate information. They should add a margin of conservatism due to data deficiencies and other uncertainties, and they may rely on expert judgment. And this is important information that you can also use in order to assess how banks actually deal with climate risks right now, and probably also issue guidelines on how you expect them to deal with climate risks in Pillar 1. So when talking about expert judgment and overrides, overlays are very important. And the ECB did a review recently saying that traditional IFRS models fall short of reflecting the credit risk expectations for novel risks in a rapidly changing environment, amongst other environmental risks. And hence, they say overlays are a very useful tool for that. But they need to be delivered with strong governance and transparency. So this is something that you would want to bear in mind when recommending the overlays. It's important to not just apply umbrella overlays, but ideally do in-model adjustments to quantify the impact of novel risks using scenarios and simulations. So in their review, what they find is that most of the of the banks that they asked were using overlays after the model results have been obtained, and 4% use in-model adjustment. But we see also that environmental risks in terms of the emerging risks are currently considerably under considered, well, not considered compared to the other emerging risks. So the ECB recommends or states that some re-rate all their clients consuming higher levels of carbon emissions or higher costs. And they say we recommend that others follow the good examples set by these banks using such in-model adjustment or overlays for the effect of higher interest rate and so on, for modeling, amongst others, environmental risk-driven default. So this is, for example, something that you can easily recommend also to your constituents. Moving from the valuation part to the risk weights, we see that the Basel Committee has also issued part of the FAQ with regards to the risk weights. And importantly, so basically right now, the risk weights considerations for climate mainly refer to basically the principles of the overrides. But what has also been discussed in the context of new emerging risks, mainly crypto assets, is to adjust the risk weights themselves. So on the left-hand side, we see the standardized approach for credited risk overview table with the standard risk weights that are now in force. And on the right-hand side, we see an additional consideration of risk weights for crypto assets. And crypto assets are emerging complex risks, and they share some, like in the issue of quantifying the risks, they share core features like climate risks. And basically, the crypto asset recommendations are very detailed and say that there's different groups of assets, which can either be in group 1 or group 2. And in group 2, we have group 2A and B assets. And the A assets would have to be added with the standard 100% capital charge, but B assets, which are the highly risky ones, would have 1,250% risk weight, which means basically a one-for-one approach to finance these assets. What does that mean? For each, for example, dollar that a bank wants to give or wants to invest in a crypto asset or wants to give as a loan for a certain crypto-related project that falls within that category, it needs to have one equivalent US dollar available in its balance sheet. So the effect of that would be that any losses occurring within that investment would have to be fully covered within the balance sheet of the bank. And this is something where we see a huge degree of additional guidelines and considerations how and when to integrate crypto asset related considerations in the banking framework in the standard Basel III. And there might be approaches to set up a similar framework also for climate related or other climate and environment related emerging risks. I think going through these crypto asset components is super useful also to understand better how climate-related and environment-related risks might be tackled by supervisors. So even if the approach is not there yet for climate and environment-related asset aspects, it might help you to go through the guidelines here in the official framework in the standard considerations part in order to understand how you could also start to work on climate-related issues and environment-related issues. So basically, this is just a reformulation on the groupings and on the aspects that could be undertaken once the supervisor finds that the risk weights have not been adequately addressed, which is the standard toolkit, additional capital charges, provisioning, and supervisory limit or other mitigation measures. That also would be important and interesting stuff to consider when talking about climate and environment related issues. So what are the next steps that have been undertaken already and the ones that we would suggest would also be useful? The European Banking Authority issued currently a report in October 2023 on the enhancement to the Pillar 1 framework to capture better environmental and social risks. And what they do is basically they recommend based on different time horizons, so short-term, medium, and long-term perspectives. They do this to account for the increasing amount of information that becomes available, the more the risks are integrated. So the medium term relies to some extent on the short-term activities. So that's why I think a phased approach makes totally sense. I very much recommend you to go through the Pillar 1 proposals of the EBA in order to understand what they might or what they recommend the regulators in the euro area to do. And that would also be a super important and interesting source of inspiration on how you and your jurisdiction might want to address the process. But they have also some shortcomings and some misunderstandings in their report in terms of how the risks would materialize and eventually be solved. So the report is an important source of inspiration, but it could also be, like, I would take it with a pinch of salt and always try to understand what is really useful and preventive and preemptive and not just reactive. So far, it's mainly reactive. And then second, for the ECB, they just released in February a guide to internal models, including general principles on climate and environment-related risks. And they reaffirmed that overrides and expert judgment might be important, and they recommend a consistent use of risk drivers in probability of default and loss given default calculations, including the climate risks. In addition, recommend or ask for margins of conservatism to accommodate estimation errors and uncertainty. So these are just some examples to showcase how you can basically recommend within the models use guidelines certain safety walls or safety thresholds that you want the banks to fulfill. So what does that now mean for the useful next steps to integrate climate risks in Pillar 1? In terms of the evaluation, we think it would be very important and super useful to integrate the BCBS 2022 FAQ in your own regulatory guidances for credit risk, market risk, and operational risks. Basically, as it is done now, most of the supervisors sort of copy-paste what is written in the Basel requirements, and they should just extend this copy-pasting beyond the main body of the text in the Basel to also add in not just the footnotes, but only the FAQ in the footnotes. It's a very simple exercise that could do a great deal. Then issue specific guidelines for the due diligence processes, for the overlay recommendations with a margin of conservatism, and ensure that the internal capital adequacy assessment process and Pillar 1 evaluations are aligned. Second, on the risk weights, for fossil fuel assets, they could be treated like cryptocurrencies, so be assigned to specific risk classes, and with every fossil fuel new explorations and expansions being assigned the highest risk weight, so a one-for-one approach. The reason is that the IAA says no more additional exploration and expansion of fossil fuels is in line with the Paris Agreement, and this is why a one-for-one approach would be useful. Assign further minimum 150% for the production of fossil fuel and their related business to account for the additional future risks. And the same holds for assets without credible sound transition plans, so be it for corporates or be it for project assets, having similar classes with higher risk weights depending on the quality and the credibility of the transition plans. I already teased you that the EBA report has some shortcomings. One of them is the reliance on the financial market efficiency to correct the models itself. This is not adequate. They say as soon as defaults and losses start to materialize, the deterioration of the model performance would be assessed in an early phase through the existing mechanisms of annual review of estimates. We have seen that this was not true at all in past financial crises, and therefore they missed the opportunity to undertake a more active approach to contain the probability of such climate Minsky moments for financial stability. And this is where I would like to hand over to Pierre in order to talk more about the systemic components. Thanks a lot.
Thank you very much, Julia. Let me share my screen. as well. So I hope you can see it. So Julia showed you that climate risk are already well covered in Pillar 1 at the microprudential level, with pretty useful guidelines already and examples. And I would like to look at another aspect of capital requirement, which can come from a systemic risk and macroprudential policy. So this is much more exploratory than what Julia presented, since it's less covered by current regulation, but we think it's an important aspect to look at as well. Yeah, let me know if you don't see the next slides. So just as a starting point, financial supervisors, international financial supervisors like the Financial Stability Boards or the SRB or the BCBS have highlighted that climate risks are potential systemic risks. Julia has alluded to when she said that it's climate risk can be very correlated, and that can represent a risk for the entire system, not just for financial institution individually. And what we also know about climate risk is that they are very likely to be underestimated. This has also been highlighted by the Financial Stability Board and the NGFS. And when risks are underestimated, then that's another reason to consider macroprudential policy. What we also know about climate risk at the system level is that they can, the climate risk can affect financial stability in a very different way. And this is, how they will materialize is very dependent on the path that economies will take in the transition. So what we know is that climate risk will materialize for sure in one way or the others, either in terms of transition risk or physical risk, or a combination of them. But the level of risk for the financial system depends on this path. What research has also shown is that in terms of financial stability, the best scenario that we can have is an orderly transition starting now. So in most of all of the research that I know from central banks, it shows that the worst case scenario for the financial system is to have no transition. In that case, you will have a lot of physical shocks, and that could put financial stability at risk. If you have an early transition, then you can kind of mitigate physical risk, and that gives you kind of that minimize risk for financial stability. And that's financial stability is something difficult to precisely measure, but according to different indicators that we use for financial stability, like probability of default of firm, loss given default for financial institution, kind of all these indicators, when you look at different scenarios, they are lower when you have an orderly transition. So I think for supervisors, you have an interest to see the transition because it's the scenario that minimizes risk for financial stability in the future. Now, the flip side of that is an early transition is good in the long term, but it comes with a front-loaded transition risk. So the transition risk materializes a bit before, and that can sometimes constitute a bit of a trade-off when you think between short-term and long-term. So that's what we know about climate risk and financial stability. And when you say that climate risk are potentially a systemic risk, then comes the question on how to address that with macroprudential policy. So, of course, if you have a potential systemic risk, then you also need an adequate macroprudential policy response. And in the context of climate risk, financial supervisors have started to explore the options in terms of macroprudential policy. The main conclusion that they have is, first, you need a holistic response. There is no single tool that will kind of address the problem. And it's very important to start with a very sound microprudential policy. And that's what Julia explained to you before. You first need to have a strong macroprudential policy to address climate risk at the institution level, to be sure that risk do not become systemic. But that even if you have, each institution does a very good job in addressing climate risk, there is still a need, we think, for some macroprudential response at the system level. And we also, so research have shown now that, in the existing macroprudential policy toolkit, you have instruments that you can deploy to address climate systemic risk. You can use them. You might have to adapt them a bit, but there are some tools that you can use, and I will describe one, which is a capital-based instrument, which is the systemic buffer. I gave you examples of papers that look at how you can address climate risk with macroprudential policy. As a background, a good macroprudential policy in general has at least two objectives. First is to increase the resilience.
Well, Pierre, I think we've just lost you. Can you still hear us? Julia, I think Pierre got disconnected or something.
Yeah, I think so. Okay, let me try what I can take over and share the slides that he wanted to present. So I can, I guess he's back.
Can you hear me now?
Yeah, okay. Good to have you back, Pierre.
Sorry.
It's all right.
Yeah, did I leave on this slide or before? Yeah.
A bit before.
I think it was the one.
Yeah. So, yeah, just to sum up, a good macroprudential policy has two objectives. One is to increase the resilience of the financial system, and one is to mitigate the buildup of systemic risk. And this should also be the same for macroprudential policy addressing climate risk. And I will show you now one potential tool that financial supervisors can use to address systemic risk from climate risk at the macro level. And it's also a capital-based tool, so that fits in pillar one in terms of macroprudential policy. So this tool is systemic buffers. It's not a new tool. It's something that financial supervisors have used for other risks. In Europe, for example, you have what we call systemic risk buffers, or SIRB, which are capital-based tools that European authorities have implemented to address systemic risk, which have features similar to climate risk. And the map shows you the countries that have currently implemented such a tool. In the past, other countries have used it. So how would a capital buffer work for climate risk? I think what is important is that this tool has three components. One component to absorb physical and transition risk from climate risks, and this is a function of both individual and systemic exposure of the system. They need to be a component to mitigate the buildup of climate risk. And I think in the context of climate, this is important. As I explained, the best way for to guarantee financial stability in the future, so to mitigate the buildup, is to have a transition. So this mitigating component should reflect the contribution of individual institution to future systemic risk. And that's basically the contribution of financial institutions to the transition. If they contribute to the transition, then they mitigate climate risk for the whole financial system in the future. And the third component is a dynamic adjustment, which reflects the evolution of where we are on the transition path. If we are on a transition, like on an orderly transition path, then we are decreasing risk for the future. If we are on a non-transition path, then climate risk for the future are increasing, and that should also be reflected in the tool. So this is a scheme to how we think such a macroprudential buffer should be conceived. So three components: one common component for the whole financial system to absorb transition and physical risk in the future. Then we think that they should also be an individual component, absorption component, which basically is a first line of defense. So this component is calibrated on the individual exposure of firms. And the idea here is to say that if one firm is very much exposed to transition of physical risk, that's where the systemic risk will hit first. So this firm should have a higher absorption component to absorb this shock and then not transmit them the rest of the financial system. So this is an important. I think this distinction between common component and individual component is important to address risk where they are, and have a higher, let's say, protection where the risks are to kind of decrease the likelihood that we have a transmission to the rest of the system. And the third component is what I call the mitigation or component or containment component. That's basically a component to reward for financial institutions that contribute to the transition, because by contributing to the transition, they also contribute to lower risk for the financial system in the future. So basically, the additional capital that will be added with this buffer is the sum of these three components. And the last part is this dynamic component. As you know, let's say that we start now with a certain level of absorption component. If we see the orderly transition is happening, then basically physical risk for the future are decreasing and we can reduce the buffer. If we see that the transition is not happening and that we're heading to a hothouse world, then basically physical risk for the future are higher, and we could adjust the level of the buffer. I don't know, like in terms of how to implement that, Julia highlighted the margin of conservatism principle. I think that applies to with macroprudential buffers, because risks are likely to be underestimated. We are totally aware that data are not perfect now, so we suggest a progressive deployment, starting with what the data we already have now for the risk and an institution where we have data, and then progressively develop as data also improve. I think it's very difficult to calibrate such tools. So we suggest also a try, evaluate, and adjust approach to start with something and then see how that plays out, and then adjust for who is learning. An international coordination is warranted. Systemic risk is a global risk, so it should also be addressed globally, but it's not necessary. We've seen with European supervisors and the systemic risk that each supervisors can do it yourself. And also, I mentioned here a concentration. I mentioned the capital risk buffer here, but in terms of macroprudential tools, there are also other tools that have been highlighted, like concentration risks, and yeah, that could also be looked at. I just want to highlight that there is a lot of uncertainty, or when you want to calibrate such tools, you have less preciseness than with other risks. But what central banks and academics have highlighted is that the risk of inaction in terms of climate is far greater than the risk of acting on partial data. So you're better to start with something now, because basically where we will end up really depends on the measures that are taken now. So sometimes in the context of climate, it's better to start with the data we have, even if they are not perfect, than to wait for too long. So that I stop here my presentation. Happy to take questions.
Okay, thank you very much, Pierre, and thank you also, Julia. I think that was a really kind of comprehensive presentation, and we had a lot of ideas and thoughts and suggestions there. So this is very much a chance now for people to ask any questions, or if they need any clarifications, then please do so. You can just put your hand up and then ask over the call, or if you prefer, you can also type it into the chat box. And as Julia just mentioned there, if you do want a copy of the slides, then those are available. So feel free to get in touch with Julia, and she can send them on to you. Maybe I can just quickly start off the discussion. Obviously, Pierre, the stuff you presented in the second half was really interesting in terms of it's such a big question, and it's so difficult to quantify, as we saw from Julia's presentation, that perhaps you need to do it at the macro pro level and incorporate it into the systemic risk buffers, and perhaps having this kind of climate risk systemic add-on or buffer would make sense, since it's across the whole system. I guess the difficulty, or perhaps some of the challenge, will be, well, how do we quantify which bank is the worst, right? And which is the best? You can have overall plans, you can have a lot of information, but until you get the actual detailed numbers, it's hard to do that. And what I took away from, Julia, your presentation on the Pillar 1 is, although there's guidance from the Basel Committee and so on, it's still not at the level where there is a climate risk factor as part of the PD and LGD calculations, as it were. So in effect, the guidance is asking supervisors to kind of take a decision, and it almost becomes like a Pillar 2 supervisory review, where they then put an add-on if they feel it's bad or not. So I don't know, Julia, do you have any thoughts on, is that a correct summary, or do you think we should be pushing the Basel Committee further to incorporate climate risk more directly into the kind of PD LGD framework, and hence try and get a more detailed analysis of this?
So I think it's not an either or. It's neither either or Pillar 1 and Pillar 2. It's also not either or, is it sufficient now, or should there be more done? So I think it's both in both aspects. On the one hand side, we've seen that Pillar 2, for an effective implementation or for effective supervisory review processes very much relies also on Pillar 1 being well calibrated. Well, Pillar 1 being clear enough in order to raise issues then in Pillar 2 or supervisory review processes. So the clearer the guidelines at the first place for Pillar 1 capital requirements and especially the risk-weighted assets, the easier for supervisors then in Pillar 2 to raise the topic when they consider it, or to ask, okay, do you actually consider climate-related risks within your risk-weighted asset calculations? How do you do it? And then the supervisors can assess now, as it stands now with the due diligence requirements, whether they consider it sufficient or not. In other ways, for now, they could add the Pillar 2 add-ons. But at the same time, we also see that, for example, due to the issues related to the standard calibration of risks in the climate and emerging risk context in general, we might need to have these additional risk weights, for example, as we have seen in the crypto assets. So next steps would be for the Basel Committee to definitely consider these, and also for individual supervisors to assess, are they happy with what the Basel Committee proposes now, or do they fear that the financial sector remains that exposed to the risks, or that they pose too much burden on the individual banks in order to assess themselves the climate risks, that they would feel probably more comfortable with having risk-weighted adjustments. So I think it's, as Pierre already said before, it's not a single solution that solves it all, but it's all components. And that's also why Pillar 1 is very important, to get the rest of the components right, and the rest of the components can support Pillar 1 as well.
Yeah, thank you. Yeah, Pierre?
If I can just add, I think Pillar 1 and Pillar 2 work together. So Pillar 2 is there to check that the risk management is in place. And one way to check it is how banks treat climate risk in their Pillar 1. Do they adjust what are the models they use? Do these models really take climate risk into account? So that goes together. And I think what the Basel Committee did well is also to guide or to give some guidelines on how to reflect that in Pillar 1. So for me, it's clear. So climate risk is in the traditional risk component that banks are used to work with. So there you should add this source of risk. And you have clear guidance like a margin of conservatism. That's important given data deficiency now, and also the underestimation. So use that. If you don't have data, you can rely on expert judgment. So there is no reason not to integrate that in Pillar 1. And if it's not done by banks, then there is a Pillar 2 component to say you're not addressing it correctly, then do it. Just on the macroprudential, there are several ways to see whether banks are contributing or not to the transition. So the last component that I talked about. So you can look at directly their balance sheet. You can also look at whether they have a good transition plan or not. That could be also an indicator on which to assess whether a bank is contributing to the transition or not. And you can also have, I'm finishing with that. You can basically also assess look at what the bank is doing for supporting clients in the transition. That could also be an indicator of contribution to the transition. So there are several ways to assess that.
Yeah, thank you. Thanks, Pierre. Yeah, I think the big takeaway is that there's quite a big onus on supervisors to really understand what each of the banks are going to be doing in quite a lot of detail, because there'll obviously be a temptation for the banks to almost greenwash the process and throw tons and tons of documentation and say, hey, look, this is what we're doing. But you need to filter through that and say, well, what's the actual impact on your lending decisions, on your pricing for the products, and how is it affecting, what's the strategy that you have in place? So that's that's certainly a key thing. But I think you're right. You'll have to be a multi-pronged approach across different tools and policies, given the complexities here. I can't see anyone raising any hands or questions. I don't know if it's just my system, but if anyone wants to ask a question, please unmute and feel free to ask it or type it in the chat box. Just while we're waiting for that, maybe another quick point, and particularly for given that we are focusing here on the ASEAN +3 countries, one of the challenges might be that, well, actually, by putting in these additional climate risk measures, you are penalizing emerging markets even more so, right, in terms of being able to do business and growth and development and so on. Have you kind of come across that challenge, and do you have any thoughts around it?
So, I mean, by putting regulation, I'm not sure you necessarily penalize emerging markets. If the standards are global, you also penalize how advanced economy are working now. They are the one that need the most transition. So
yeah,
I mean,
I guess what I mean is, so for example, because there's different stages of development, right? So a lot of the emerging market economies are still using coal a lot more, for example, or burning other fossil fuels and that sort of thing, and that's quite a key part of their economic growth as well. So by suddenly saying, well, all these things will now have a much higher capital impact, banks are going to be disincentivized from lending, and it's going to affect their their economies. So I meant the challenge in sort of that fashion.
Yeah, I think the challenge is basically how to include then the transition plans associated with the assets. So a coal asset in itself, or a company involved in coal business itself, should not be penalized for being involved in coal right now. But the core issue is to use transition plans and to use their transition activities in order to then assess the risk weights. So it's not about penalizing those who want to transition. It's about penalizing those who do not have transition plans or do greenwash their transition plans, which then exacerbates the financial and economic and societal risks in the mid to long term. So it's more a precautionary measure, which needs differentiation, obviously.
Okay, yeah, thank you. So I missed one of the hands on the system. My colleague Alex wanted to ask a question, but he's joined me in the room here. So Alex, yes. Give us a quick introduction to yourself, and then you can ask the question as well. Do you want to?
Okay, thank you very much. Thank you, Julia and Pierre, for your quite a frontier, your research and a lot of new ideas for us. In fact, I just have a minor question. Still, how to deal with your suggestions and also your observation, how we are going to deal with like the imbalance between the heavier and heavier, especially in fact dramatically heavier, like the preparation and banking testing that process with like our current world, more and more like big events that need us to have quite quick assessment and reaction, because you see, like from version to version of the Basel, seem like the data collection and a lot of technical details and modeling details, and also like the higher standards for update of those key parameters, those data, that all make the whole preparation and stress testing process going to be dramatically heavier and heavier. But while you see like a lot of recent years, those big events from pandemic, like SVB, and also more related to our topic, like energy crisis, those big events or usually suddenly happen just above our imagination, and needs us to really have a quite quick reaction. Then, but you see, within like our current bank testing exercise, taking into consideration like transition risk, we find that in fact some countries even they couldn't fully implement the standards of like last version of Basel. Still like lacking of some key data. Not further going to mention like taking transition risk into consideration. So yeah, I just want to talk with you based on your observation and your experience, how to better deal with this imbalance. Thank you.
Nice, easy question.
Yeah. I could quickly start and Pierre could add on that, probably. So on the one hand side, in terms of Basel becoming more and more complex, there has been, like with the move from Basel II to Basel III, there were some internal model provisions that have been abandoned actually. So it became less complex for supervisors to assess whether the standardized approach or the internal modeling approach is appropriate, because they defined a standardized approach across various additional elements. We might see that as well in the light of climate-related issues. And I definitely acknowledge that if you want to implement a detailed assessment of every single item within the Basel framework, you need more capacities. But what you can also do is to define the elements you want to see, do a tick box exercise for the banks, and then they ensure, like within, like it can be even just a one-pager in the supervisory reporting, at least, to provide you with the information that you want to see. So you don't have to skim through all the documents, but you ask them for the elements that you want to have. That's basically a first quick fix. Second, you were totally right, obviously, in saying like you're already preoccupied with so many different crises and issues that you need to handle quickly. The issue with like that we want to tackle and that Basel wants to tackle is basically the reduction of these risks and these events happening in the future, because it's clear that climate and other emerging risks will become more prevalent. They are compound, so hence supervisors will be more and more busy in the future if these risks are not tackled now, by default, basically. And that's why they are so keen to have climate, environment, and other emerging risks now being more preemptively managed instead of reactively, because it will overburden supervisors otherwise. And this adjustment based on whatever happened in the past being integrated then in a review of Basel, that's just beyond what should be done. And that's also not useful, because the costs will be borne by economic agents and private households in any case. So the more preventive approach is exactly basically one of the approaches to limit what the issues you were referring to. And I think it's a useful consideration for supervisors as well to start thinking through how are we more preventive and less reactive in the future.
If I can just add, I mean, it's a learning process for all, for banks, for supervisors, anyway. So, I mean, you cannot start with climate risk the way you're treating, for example, a business cycle risk now. You know, business cycle, you have 3, 4, 5 business cycles that you have seen, that you have experienced, where you can see the magnitude. So there you have precise measure. With climate risk, you cannot have that yet. So it's a learning process, but I think it's important to start implementing something, because it's also a learning process for supervisors. And by starting to implement some tools, even like on a limited segment of the market. For example, big banks, we have much better data for big banks than for small bank. You can draw on this experience. So you have some risks that are very evident. So maybe start with these ones instead of trying to have the perfect view at the most granular level with very precise estimation in the beginning. So I would suggest that also, because as Julia just highlighted, it's important to start with something now to also decrease the risk in the future and be less busy in the future, and making things complex, boxed, and that's also one way for banks not to do anything. And I mean, I'm also maybe taking another view there. You also have simple tools like leverage ratio that are very, very simple tools to implement, and that increase resilience of the financial system in general to any kind of risks. So you don't always need to have a more complex and precise, regulation to have tools that actually prevents things to happen. So.
Thank you very much for your quite enlightening ideas. In fact, sorry, just to have a follow-up idea, maybe to further talk with you, because you are so experienced on these big and great issues for the future. In fact, like nowadays, a lot of like technical tools, and also like central bank, commercial bank, they are developing some like a simplified way, user-friendly way, although not on like Basel's micro-prudential calculation and also on transition risk-related things. But already we see some like regional central banks, commercial banks, they are going to develop some like simplified tools for quickly efficiently accessing some other types of risk. For example, of course, that way is going to lose some accuracy for the accessing itself. But the advantage really is it could be super efficient. For example, like they just do some pre-calculation, and just for the user to use, you just pick out maybe you consider you most likely to fall within which category, and you just put yourself within a category, and they are quickly giving you some numbers, the calculation assessment numbers for you to consider. So I'm thinking about, it's like the idea of the rule of thumb, quite simplified way, also losing some accuracy, but it wins on the efficiency side. So I want to ask you, is it like also a possible alternative way to deal with like this imbalance between heavier and heavier process with like our quick reaction for those big events? Thank you.
I mean, my quick reaction is, it's as I say, it's a learning process also for supervisors. You can and banks. You can start with something that, like you suggested. It's important to evaluate it quite quickly, and then to see how you can improve on that. I think it can only be done learning by doing. If you do something, it's important also to evaluate quite quickly, or constantly monitor, and then as data will also develop, be more precise. So then you can reshape your tool. But if you don't start with something, then you're gonna wait until everything is perfect, and that's never gonna happen, basically.
Yeah, really appreciate your idea of learning by doing, and let's just see the effects to see how to like choose between those alternative the process dealing with these issues. Yeah, thank you.
That's basically also what MAS, for example, applies in their foreign exchange reserve management, that they play around with multiple tools and gather information on how each tool performs in order to scale that up then to the entire portfolio in due course. So I think some central banks are experimenting with that. And I definitely would subscribe to what you say. So I think it comes also from the machine learning terminology, right? So accuracy and efficiency considerations are important. In the way how the Basel weights, for example, the risk weights are basically set, it's a general approach, which is never accurate in a sense like it has been developed by a model that has been backtested for the past 200 years. So Basel has already this generalized, very quick fix approach. And it should be also something that guides the risk-weighted asset calculations in the future, because what we know is, given the deep uncertainties and the heterogeneities, there will never be a point where we have 100% accuracy. But what we assume now is implicitly a zero risk for climate, and we know definitely that this is not accurate. So we are using something which is for sure inaccurate, and then it's better to use something which is a bit more accurate than a risk of zero.
Yeah, I think you make a good point, Alex, because Basel itself, it's shifting back to standardization, right? Saying it was too much the other way, trying to model everything. So maybe some kind of standard climate risk weight, it's easier. We don't have to go too much into it. Just give a rough estimate and let you get us there. So,
yes. Yeah.
Okay. All right. Thank you very much. I'm afraid we've overshot the webinar a little bit, so we are out of time. But it would be great to continue this debate. So if anyone has other questions or thoughts or observations, please do share it with us and with Julia and Pierre as well. And if you're interested in the presentation, then we can also send that to you. And perhaps we can work on some more quick guidance around this, maybe summarize some of the key kind of thoughts from today's webinar in a quick note or something that people might find useful, Julia. Yeah.
Sure, yeah. Thanks so much for having us. It's great to be in the discussion with you. And I'm very much looking forward to take on that with you and all the participants who are interested in engaging further.
Okay, great. Thank you. And thanks for sharing your email as well, Pierre. Okay, thank you very much, everyone, for your time. And thank you especially to Julia. Yeah.
Thank you. Thank you very much.
Thank you.
Thank you.
Bye-bye.
Thank you. Thank you. Bye.